Hello, my name is Paul Beland, and I am the Deputy Director of Research at CFRA. Today, I'd like to discuss equity valuation. This is intended to be a high-level overview of approaches to equity valuation and the key metrics to use when evaluating a stock. First, at CFRA, we believe in the fundamental principle that the value of an asset is the present value of its future cash flows. As a result, investors are not just purchasing shares of a company, but they are also buying into a set of embedded expectations about how that company is going to perform in the future. When it comes to estimating the value of an asset, CFRA does not follow a one-size-fits-all approach. Our analysts look to apply the most relevant valuation tools to the specific company or industry, often using multiple methods to help triangulate around what we believe is a reasonable valuation for a company. Today, I will discuss two key approaches to valuation: intrinsic valuation and relative valuation. Intrinsic valuation relates the value of an asset to its ability to generate cash flows and the risks related to those cash flows. Free cash flow is typically defined as cash from operations less capital expenditures. In its most common form, intrinsic value is estimated using a discounted cash flow model, or a DCF. A DCF is a direct valuation technique that values a company by projecting its future cash flows and then uses the net present value method to value those cash flows in today's dollars by accounting for the time value of money. In a DCF analysis, the cash flows are projected using a series of assumptions about how the business will perform in the future and how this translates into free cash flow generated by the business. Here we show an example of a DCF analysis. Using dummy data for fictitious Acme Corporation, we forecast unlevered free cash flow through 2024. Unlevered just means before paying its financial obligations, like interest on debt. We prefer valuing companies using unlevered free cash flow because it allows for an apples-to-apples comparison of cash flows produced by companies with different capital structures. And it also allows the analyst the ability to test out different capital structures to determine how they impact valuation. On the next slide, in solving for company value, we have to determine the asset's terminal value. This is the value of free cash flow the company is expected to earn beyond the explicit free cash flow period through 2024, as illustrated on the previous slide. To do this, we use a perpetual growth model here, which effectively solves for the terminal value by using a 2025 estimated free cash flow and applying a risk and growth factor to solve for free cash flow to be generated into perpetuity. To look at it as a formula, this is simply 2025 free cash flow divided by R minus G, R being the discount rate and G being the growth rate. Next, we need to bring our forecasted free cash flows and the terminal value into today's dollars using the net present value method. Here we use a company's weighted average cost of capital, or WACC, as the discount rate, which you'll see on the right here. To estimate the company's cost of equity, we use the capital asset pricing model, or CAPM, which uses a risk-free rate, the 10-year US Treasury in this case, a market risk premium. This is the estimated return expected to be in equities versus the risk-free assets. And we use beta, a measure of stock's volatility, to factor company-specific risk. Once we factor any debt costs, we solve for the WACC, which we use as a discount rate to present value future cash flows. A way of thinking about the discount rate is if you're going to invest in a company and its future cash flows, what's the return you require to take on this risk? Once we present value our future cash flows, we need to factor in a net debt the company might have to get an equity valuation, which, when divided by shares outstanding, results in our estimated per share value. In this case, we see Acme Corporation as undervalued by the market by 11%. So what are the advantages and disadvantages of using DCF? Well, number one advantage, DCF is based on an asset's intrinsic fundamentals, and it's less exposed to market moods and perceptions of market value. Number two, and most importantly, it forces the investor to really think about what they're buying in an asset. What assumptions are you making to value this asset? Are they realistic? Disadvantages? Well, one, as illustrated by our Acme Corporation example, there are a lot of inputs. These inputs can be difficult to estimate, and small tweaks in these inputs can have a big impact on valuation. And number two, in addition to that, depending on market sentiment, it might not be effective in finding under or overvalued stocks, as it doesn't look at relative valuations of competitors. Speaking of relative valuation of competitors, relative valuation estimates the value of an asset by looking at pricing of comparable assets relative to a common fundamental variable like earnings, cash flows, book value, and sales. A very common multiple is price to earnings, or PE, effectively looking at the earnings the company generates relative to the price of the stock. However, despite its often popular use, there are significant limitations to the PE ratio, including the accounting influence in the denominator. Earnings are not cash. There's also quality of earnings concerns that investors need to be mindful of. In addition, the PE ratio does not take into account the health of the balance sheet. Alternatively, a multiple that does take into account the health of the balance sheet is price to book value, which looks at the company's market capitalization relative to its shareholders' equity. However, this metric is also determined by accounting rules and assumption and is heavily influenced by the original purchase price paid for assets and any accounting adjustments made since. This metric can be useful, however, for asset-intensive companies, but it's almost meaningless for companies like Apple and Google, for example, as their intellectual capital, brand, and IP are much more valuable than the assets on their balance sheet. Revenue multiples, on the other hand, like price to sales, have broader use cases and are less affected by accounting choices, but still not immune. The timing and type of revenue that the company may be recognizing can at times blur economic reality. However, the price to sales ratio can work well when analyzing growth companies that are focused on top-line growth over near-term profitability. As we've been talking about relative valuation and common multiples, we've been mostly focusing on multiples related to equity. Conversely, when you buy a business, for example, you also acquire any outstanding debt. In this case, it is common to value the firm or the enterprise value relative to operating income, or the earnings before interest, taxes, depreciation, amortization, also known as EBITDA. This metric also helps create an apples-to-apples comparison for companies with different capital structures. In addition, EBITDA can be viewed as a proxy for free cash flow, but it does not take into account capital expenditures, which can vary dramatically by industry. Then we have sector-specific multiples. While earnings, book value, revenue, and EBITDA multiples can be computed for firms in any sector across the entire market, there are some multiples that are specific to an industry or a sector. Examples include, enterprise value to subscribers in the telecom or cable industries, or enterprise value to funds from operations in the REIT industry, and enterprise value to reserves or production in the oil and gas space. These can be very useful, but not always directly related to fundamentals, and they only work for specific industry subsets. So what are the advantages and disadvantages of relative valuation? Well, unlike the DCF, relative valuation reflects current moods and perceptions of value in the market. Number two, they're very easy to calculate and understand. Disadvantages? Well, relative valuation is based on the assumption that the markets are correct in aggregate. If the market is significantly overvalued or undervalued, the relative valuation method can be misleading and fail. In addition, key variables like risk, growth potential, longer-term free cash flow generation capabilities are ignored. Multiples tend to be very short-sighted. To summarize, multiples are easy to compute and understand. They take into account market moves and perceptions, but there are limitations to their usefulness in determining an asset's value. While there are many models and metrics to truly grasp the value of an asset, you need to understand all of them, use the most appropriate for that sector. Knowing which multiple metric is most important to a company or an industry is a key part of mastering valuation. At CFRA, we use all available approaches. We bring a forensic accounting lens in as well, which helps us with quality of earnings and cash flow, and this helps us triangulate on value. Thank you for your time today, and for more information, visit us at cfraresearch.com.